I'm talking to you on Thursday afternoon in Singapore. On Wednesday, after the close in the US, which would have been our morning here on Thursday, the big AI chip company, Nvidia, reported its earnings. It gave its earnings call. The numbers it printed, what it said on the call, were all largely what the market expected. Nevertheless, the reaction of Nvidia's stock in after-hours trading was to drop about 3%. Looking at S&P futures, no one is really, that's not creating any concern about the broader market. S&P futures right now are just down a small bit. And I think you can look at Nvidia's stock and say, well, that's just profit taking. They had a result as expected. The shares of Nvidia are up about 100% since the low that they hit, or this year's low that they hit in April after Trump did his Liberation Day speech. And people are just taking profit. And once they take their profit, the shares might start going up again. In actual fact, I would not be surprised if at the end of the day on Thursday in the US, Nvidia shares are higher. And if they are higher, well, then the S&P is going to have another record close because it did close at a record on Wednesday. If you listened to me speak last week, the S&P being in a record would be a little bit of a surprise. You know that's a little bit of a surprise for me. Well, I said last week I expected the markets to move sideways, even a little bit lower, because with earnings season already having ended, there wasn't a lot of things on the calendar to really boost U.S. equities higher, and I expected the market to sag a little bit. As it was, we did have a market boosting event. We had Jay Powell gave a relatively dovish speech in Jackson Hole. What did he say that was dovish? Well, normally when Powell speaks, he really isn't very clear. Like if he wants to show that he's concerned about the labor market, he'll mention the labor market several times in his speech, and people listening to him will have to infer from that he's concerned about the labor market. But when Powell was speaking on Friday of last week, he was much more explicit. He said, given the last several data points from the non-farm payroll data from that the U.S. had, that the relative weight of concerns of the Fed policymakers on the labor market versus inflation had changed a little bit. They have a little bit more concern about the labor market. Of course, the reaction of fixed income traders to that is the odds of Fed rate cuts this year went up quite a bit. And of course, bulls on Wall Street love rate cuts, and the stock market went up a lot. And leading the way, of course, were all the interest-sensitive sectors. So you had small-cap stocks, which borrow quite a bit of money on floating rates. They had a very strong day last Friday. You had regional banks go up quite a bit. That helps them with their net interest rate margins and all this sort of thing. And then finally, rounding the thing off, you had the home builders and related companies go up quite a bit on Friday. Having just mentioned home builders there, I'd like to take a little bit of time to talk about how important mortgage rates are to what's going on with U.S. consumers. One of the shows on YouTube that I like to watch is the new show Breaking Points. And the commentator there, Sagar and Jetty, he usually gives this example. He gives an example of two families who live on the same street in very, very similar houses, have very similar incomes, have very similar expenses with only one difference. One family had bought their homes when the mortgage rates were very low and they were able to lock in a 3.5% mortgage, while the other person bought later and they have a much higher mortgage. And the family with the low-income mortgage is doing really, really well. And the family with the higher mortgage, they could be struggling because there are some problems going on in the US economy. And that example you can see with some of the data that we're having right now. If you look at mortgage defaults across the United States, they remain very low, although there's other signs that the US consumer is under some stress. So you have people falling behind on their payments for their cars, you have people falling behind on credit card payments, but because so many people have those low interest rate mortgages which they want to hang on to, they're making sure that they're making their monthly house payments. However, if you look at two states where the housing market remained quite active after COVID ended, and you had more people buying homes when mortgage rates were higher, and I'm talking about Florida and Nevada, default rates in those two states have jumped up. Nevada is #1 in the rate of mortgage defaults in the country right now, and Florida is #2. So what you have in markets like those two markets, which are also impacted by the fact that foreign tourist arrivals are down, and those are both big tourist states, but what you have going on there is that when people don't have those cheap mortgages, you're seeing the consumers get into trouble. So this is part of the reason why Trump really wants to see US interest rates drop, because he thinks it'll be good for people who are under stress because they're paying high interest rates on debt. And on that subject, we have a big data point coming out on Friday before the market comes out. We have what is often called the Fed's preferred inflation gauge, PCE data. The Fed looks at the core PCE. That's expected to tick up a little bit due to the tariffs, due to a few other things. The June number showed year-on-year core rising 2.8%. The number that'll come out on Friday will be the July number, and that's expected to tick up to 2.9%. Since the market expects that, I think if it gets that, and we are in a bullish frame of mind on Wall Street, we're at a record high, I think the markets move higher because there'll be a little bit of relief that we don't have a surprisingly bad number like we had from the PPI, the Producer Price Index number a week ago. So a number that's in line, and of course a number that's lower, that'll be positive for the market. If you have a number that's above, well, that'll probably first, you'll get Trump complaining about it. So far, the PCE numbers are produced by the BEA, the Bureau of Economic Analysis, part of the Commerce Department. Trump hasn't criticized them yet, but if they print a bad number, they'll get some criticism there. But the result of a bad number is some of those expectations of rate cuts, which the bulls on Wall Street really want, that'll drop. Currently, there's an 87% chance, according to the Fed Watch tool, of a Fed rate cut in September. If you get a high PCE print, that number is going to drop a bit. Currently, there's about a 33% chance that we get 3 rate cuts during this year. That'll also drop as well. So that'll be negative for the market. That'll be a big deal. But the good news, like I said, if we just get the number that the economists are expecting, I think that will be a kind of a relief to the market, and it'll be largely positive, and we're just going to continue to print all-time highs. That takes care of what I have to say this week. Talk to you again next week. Bye.